The more you listen, the more you know. This is Good Politics with Dr. Wilson and Adam Whiteman.
So we're back up and running from remote locations, and we're really excited to be back. What about the decrease in GDP? Will we see some contraction?
Right. So this is going to be huge. This is from Janet Yellen, and she's a former Federal Reserve chair. She was an Obama appointee. Let's see what Janet Yellen has to say about that.
Probably now, if we had a timely unemployment statistic, the unemployment rate would probably be up to 12 or 13% at this point and moving higher. So other sectoral indicators, daily credit card data, other data that we have just show a dramatic decline in economic activity. Probably for the second quarter at an annual rate, we're going to be looking at a decline in GDP of at least 30%, and I've seen far higher numbers. So this is a huge, unprecedented, devastating hit. And my hope is that we will get back to business as usual as quickly as possible.
She said annualized 30% for quarter two.
Yeah.
Oh, that's scary. I got the chill. That's giving me the chills. 30% annualized GDP shrinkage? Nearly a third. She's seen higher numbers than that. That's terrifying.
The stat that she's talking about is a little bit misleading because it's only they annualize it. You should know how that goes. They annualize the thing.
Right.
Imagine a football game.
Oh, you're right.
So you got a football team that plays really bad in the second quarter, and you say, if they play this bad in the second quarter and we take it out to the full game, that this is what the end.
They'll lose by
right. Well,
they'll lose by 30 points, but in reality they're only behind less than 7 or
right.
whatever.
When we get these GDP numbers, you and I will sit down and look at what the real effect is on nominal GDP, because we are probably going to see nominal GDP contract. And so the question is how much that's going to be. I don't like to look at the annualized number. I don't even like to look, frankly, at real GDP numbers because once inflation goes away, there's not going to be any inflation around here now. There's going to be the fear of deflation. So that's going to change then the real number. As long as the inflation rate is 2% or below, which this easily is, I just like to look at the nominal dollar figure. And that's because I'm not looking forward, I'm looking behind. And so when these numbers come in, especially around the summertime, once the second quarter numbers come in, we'll be able to see what the shrinkage actually is, or we'll get a better fix of it when the number comes in. But it does sound scary, though. You got a stimulus bill. It has a fiscal component. The monetary seems to be more powerful. It's what's helping to prop up the market. If you'll notice, the stock market all of a sudden isn't falling anymore. The stock market started to tank. I think people were really panicking. It was around 19 or 18,000. They're talking about the Dow Jones Industrial. But now it's back into the 23, 24 range, and that's actually extremely good. Given all the problems, you have this huge meltdown, and they're trying to intervene and prop it up. What I want to do in the monetary policy is let's hear this on clip number 2.
Brian Chung, not a good month for jobs, but interesting to see. I guess unsurprisingly, the Federal Reserve, their balance sheet has swelled to a record. My question is, does it even matter at this point? They're going to do whatever they can to save the economy.
Yeah, well, the Federal Reserve has been pretty clear on its intentions with its strategy to battle the economic impacts of the coronavirus. Over the past 4 weeks, it's slashed rates to zero and launched a quantitative easing program with seemingly no cap. And because of that, the Federal Reserve's asset holdings have ballooned over the past few weeks. Right now, the total balance sheet totals get this $5.8 trillion. For reference, it actually peaked. The largest it's ever been prior to that was only $4.5 trillion after the financial crisis. It was trying to unwind that until the coronavirus issues started to flare up, after which they began buying all different types of purchases, treasury bills across duration, agency mortgage-backed securities, and now for the first time, agency commercial-backed securities. Brian, just over yesterday, they bought $60 billion in one single day of treasury bills week over week. When you compare this Wednesday to last Wednesday, it actually expanded the balance sheet by a total of $600 billion. So at this pace, the Federal Reserve is really set to actually almost double its balance sheet over the next month or so.
Wow. Okay. The Federal Reserve started buying up everything, stocks, mortgage-backed securities, and things like that. So they're propping up the economy by purchasing all these things. Is that what they mean by increasing the balance sheet?
You've got this thing that they do now. It's called quantitative easing. And so you've got the Fed that it's going to go out there and start buying a bunch of stuff. And the thing that you have to understand is they buy treasury bonds. They buy up, sometimes they even buy bad things like bad securities, agreements that are underwater. People are having trouble paying their mortgage-backed securities. And so if you don't buy up the toxic assets, that is the way that you try to make sure that the banks don't fall. Because one of the things you don't want is for this to actually be a financial meltdown. Right now, all this is an exogenous shock. What you have is an economy that had the strength that it did have, whatever that is, we can talk about it. And then they had this exogenous shock. And if you just leave the shock in place and you don't do anything, then what can happen is this could cause a real collapse. And this is why the Fed is in there to try to prop up the deficit spending, buy treasury bonds. They're going to buy securities and things that the banks are holding in hope that this storm will pass. The one thing you should look at is the size of this. I have a graph on the screen there you can look at. The total quantitative easing under the Great Recession, the balance sheet of the Fed, it was, I don't know, somewhere around $4.5 trillion or something. This is now projected to head up into the $9 trillion range, talking total amount. And so what that means is you're basically taking all that you did for the Great Recession and pretty much going to start doubling that. And I saw today that the Fed is doing actually even more than this. So I think this graph may not exactly be right. I think you're going to look at a balance sheet that could be around $9 to $10 trillion. And the question is what effect this is going to have long run. We're going to have to postpone that discussion. And, the important point is just to understand what's happening.
When the Fed is buying up all of these assets, what's the downside?
Okay, so
is it just creating an asset bubble that, is it driving up prices fictitiously?
If an economy is good and your rates are too low and you do this kind of stuff, yes, it will create an asset bubble. But when you're in what I call depression economics, you can think of this thing as being like a fire in a building. If you let the building burn down, then you're not going to be able to, you'd have to build a brand new building. If you can get the fire out, then the building's still okay. And so what they're trying to do is prop up the market, prop up the stock market. They want to try to keep the value in the companies good because they believe this is going to be a short-term thing. The cost of it is going to be long-term. What you're going to see is the United States, the national debt, is going to increase substantially. It's going to be the publicly held debt, and it's also going to be the debt that government owes to itself because of these instruments that the Fed is buying. So the question is what the impact of that ends up being. It's possible that we could be back to a time period where our national debt is very close to what it was in World War II. I hope you know in World War II we had a national debt that was equal to the size of our economy. Okay, so it was 100% of the national debt. And when you have a situation where assets and liabilities don't match one another, and the word for that is usually called bankrupt. But so the point is the publicly held debt load of the United States is now going to get large. And the question, we have to wait and see how large it's going to be. But it could actually be 100% of GDP. We're going to have to wait and see whether we reach that mark. Before this happened, it was about 75% of GDP. And so, before the Great Recession, it was even much lower than that. I forget what the number was. I'll put it on the screen. Let's say it was around 50% or so. But it went up to substantially during the Great Recession, and I think you're going to see another substantial increase. The publicly held debt could get into the 90s pretty easily, I think. You have to understand something that's very critical. This is extremely critical to understand. These measures don't mean very much if what's underneath them doesn't mean very much. For example, the premise is that the United States is still a good bet. It's good at energy exploitation. It's good at corporate innovation. It's good at building self-driving cars. It's got companies that are trying to get into space. It does a lot of things where investors can say there's opportunity and there's value here. That's what really produces a good economy, is that there's a chance for profit, a chance for economic growth, a chance for innovation, a chance for new things to come along. If you were in another country, let's say pick any country you want to, how about the UK? And let's suppose that the UK had the same exact debt ratio, the same exact thing going on with their central bank in terms of how much they're buying up of their own bonds. Investors might look at that and say those bonds aren't really worth very much. There's a difficulty.
It's too much risk or something.
Yeah, they're not as valuable. That there could be a difficulty for the country to have to pay to meet the obligation of those bonds if they're too high, or if their national debt is out of whack for what their economy is. And so the argument is, so long as the American economy is still a good bet, then it can withstand the extra debt that's going to come along. But that's the best I can say. That's probably the most optimistic picture I can put on it.
And so that's very interesting. So the $4 million monetary package, the Fed buying up securities isn't a total loss because they can sell them back later.
That is actually a very, very, very good point. If I buy a treasury bond and I hold it, let's say I'm a regular person and I'm going to buy a savings bond. I loan the government money and they give me back this bond. And after so many years pass, they give me my money back along with a little bit of interest. The interest is really, really, really low. So what the Fed is doing is buying those bonds. Okay, so it's holding these bonds. Now, at some point in time, the Fed will sell those back in the marketplace and give the money back to the Treasury. The Fed, I don't know how the Fed is supposed to be able to buy anything. It's not supposed to have any money, I don't think, but whatever. It buys these things, it holds them, and then it will try to put them back on the market. During the Trump administration, the first 3 years, he was complaining that the Great Recession instruments purchased under the Great Recession, the Fed was dumping those things on the market. That affects the price of the bonds, and that affects the price of everything. And so it's not easy to just you just don't get rid of it. You have to carefully, incrementally reduce the balance sheet. It may take over a decade to get the balance sheet anywhere near what it was like before this started. Frankly, I think it's going to take longer than that.
Politics without allegiance. You're listening to Good Politics with Dr. Wilson and Adam Whiteman.
Dr. Wilson, did you know that all of our listeners can now listen to our podcast on any smart device?
That's right. You just say, "Hey Alexa, play the podcast Good Politics."
Hey Doc, thanks for bleeping that wake word out. And hey guys, you could also tell Siri or Google on your Android or Google Nest device. So when you get home, try it out.